In progress.
On Wall Street, yeah, competition is usually all about performance. It's who can deliver the biggest, most explosive returns.
Absolutely. It's a fight for the highest numbers.
But what happens when a major European player comes into the uh, very volatile world of leveraged ETFs and decides to compete not on performance, but just on price?
It creates a pretty powerful disruption, and it's a necessary one for active traders. But like we've seen so many times in finance, that disruption can also open the door for some, let's say, sophisticated marketing that hides what a product really is.
And that is exactly what we're digging into today. We're looking at this firm, a European company called GraniteShares.
Right.
And what's so fascinating is this sort of two-sided strategy they have. On one side, they've got these incredibly low-cost funds that are, by all accounts, genuinely better products. They're winning the fee war. But then at the same time, they've launched this other product line that, when you really look at it, seems like a trap. It's dressed up in all the right marketing buzzwords, but it's costly.
And this is really a crucial deep dive if you're someone who trades these high-frequency products, or even if you just want to understand the real structural difference in how leverage is made.
You mean the difference between using expensive swaps versus just holding the physical assets?
Exactly. And this deep dive will also show you how to spot a product where the math just doesn't back up the marketing promise.
So we're talking about real basis points you can save in your trading account versus a promise of performance that's, well, mathematically designed to fail. It's essential stuff. Okay, let's unpack this. So what we're really seeing here is a full-on challenge to the US leveraged ETF market. For years, I mean, this space has been dominated by a few big names, right?
Oh, yeah. You've got Direxion, GraniteShares, ProShares. They're the incumbents. And they've all been playing from pretty much the same playbook, structurally speaking.
And along comes GraniteShares, which is managed by Themes Management, and they've spotted this huge opportunity.
And it's not that they're trying to out-trade anyone. They're not claiming to be better stock pickers. They're just challenging the entire cost structure. They're basically saying, we can build this better and we can do it cheaper.
And when you actually look at the numbers, the difference in the fees, the expense ratios, it's not just a tiny change. It's a really significant pricing difference.
It's huge.
The legacy guys, those names we all know, are charging fees that are, what, north of 0.95%, sometimes even higher.
Yeah, often pushing up towards 1.15% a year. In contrast, leverage shares is sitting there at a flat 0.75%.
Okay, so for someone who isn't a high-volume trader, that difference, maybe 20 or 40 basis points, might not sound like a lot.
Right, it might sound marginal, but if you are an institutional trader or just a really active high-frequency trader and you're moving massive volume, that saving is an immediate, massive competitive edge.
But the real question is how? How are they getting that discount? And that's where this structural advantage you mentioned comes in. It's all about ditching the old way of doing things.
The old way being swaps.
Explain what that means.
So swaps are basically just derivative contracts that an ETF provider makes with a huge bank, like a Goldman Sachs or JP Morgan.
Okay.
And with that contract, the ETF is essentially agreeing to exchange the performance of the stock for a fee. So right away, you're adding cost because that big bank needs to get paid for taking on the risk.
And it also adds another kind of risk, doesn't it? It's something called counterparty risk.
Exactly. You hit the nail on the head. If that bank, the counterparty, were to default or collapse, the ETM itself is exposed. I mean, it's a major headache that has kept compliance officers up at night for years.
So how does GraniteShares get around this?
They sidestep it completely. They use something they call physical replication. So instead of that derivative contract, they operate as their own trust. They handle their own compliance. And this is the critical part. They actually buy the underlying stock on margin. They hold the physical asset.
I have to ask, though, if this physical method is so obviously cheaper and, frankly, safer,
Yeah.
why haven't the big guys, the ProShares and Directions of the world, just switched over?
What's fascinating here is that the sources really suggest it's about legacy. It's about their existing systems.
So they're just too big to change.
In a way, yeah. Their whole ecosystem is built around those swaps. They have these deeply embedded relationships with their banking partners. And to unwind all of that, plus go through the regulatory hurdles of becoming their own trust and managing margin in-house, it's just a monumental task. It's easier to just keep things as they are and keep charging the higher fees.
So GraniteShares, being the newcomer, could just build a better mousetrap from the start. They avoided all that baggage.
Precisely. By holding the assets themselves, they cut out that expensive middleman, the bank. So not only is it cheaper, but they also get rid of that huge institutional worry about counterparty risk. It's cheaper and it's safer. For any active trader who lives and dies by basis points, this is a huge measurable win every single day. So putting that into practice, where do we see these funds really winning? It's in their standard kind of bread and butter products, the 2X daily ETFs.
Right, so these are the funds with tickers like TSLG for 2X Tesla or NVDO for 2X NVIDIA.
Exactly.
And the consensus we're seeing is that these are just better products. They're built better, and they're fundamentally cheaper than anything else out there. So if you're a day trader looking for that leverage, they're the superior choice.
And they are not just dipping their toe in the water here. They are going all in. I think they have, 49 different 2X leverage tickers you can trade?
49. Yeah, that's a massive aggressive push to grab market share from, every corner of the active trading world.
And they're going way beyond just the big tech names, the Magnificent Seven.
Right. Our sources pointed out a whole new batch of 2X tickers they just launched, and they seem to be targeting some really specific high-interest niches.
Oh, very specific things. For example, they've got OPEG, which is 2X open door, tapping into that volatile real estate market. They have CIFG for cipher mining for the crypto crowd.
There was also GRAG for Grab Holdings, DUOG for Duolingo, even LACG for Lithium Americas, and UPSG for UPS.
It just shows they're going after any stock where active traders might want to amplify their daily moves. They're really setting the benchmark here in this 2X daily space.
So the takeaway for you, the trader, seems pretty straightforward. If you want 2X daily leverage on these kinds of names, the leveraged shares funds are just the structurally better option.
It's an absolute win. They've genuinely disrupted this whole segment with a better and cheaper model.
But this is where the story takes a turn, isn't it?
It really is.
Because they've clearly cornered the market on quality and price for these standard 2X funds. But it seems like they aren't just focused on improving old products. They're also launching something new and much more, complex.
Yeah, this is where the company seems to have a kind of split personality. We have to talk about their other big product line, the capped accelerated monthly ETFs.
Funds with tickers like TSLO, PLOO, and MSOO.
Exactly. And this is where the marketing machine really kicks into high gear and where you, the listener, really have to put on your critical thinking cap.
Because the sales pitch is, it's incredibly tempting. They're basically trying to solve the two biggest problems traders have with leveraged products all at once.
Right. First, the main claim. These funds aim to give you around 2X the positive return of a stock, but only up to a cap.
And on the flip side, they say it only takes on 1X the downside risk.
And then there's the second claim, which is a big one. It addresses volatility decay,
which is that killer erosion of value you get in daily leveraged funds when a stock is just chopping back and forth.
Exactly. Because these capped funds reset monthly instead of daily, the marketing says they avoid that decay. And they even suggest you can hold them indefinitely.
So more upside, less downside, and no decay. It sounds like the holy grail of trading products. But here's where it gets really interesting. Because when you actually overlay the performance charts, when you check the math,
the whole story just falls apart.
It creates this really bizarre, flawed situation. Your potential for big gains is literally capped by the product's rules.
But the downside protection they promise you is, mathematically, it's minimal. The structure basically limits your ability to win big, but it doesn't really stop you from losing big.
Okay, let's break down the evidence from our sources. We're looking at a specific 3-month period where these stocks saw some really big moves. And let's start with the bull case, the scenario where you would expect an accelerated fund to shine.
Let's look at Tesla. The actual stock, TSLA, went up a very strong 17.20% in that period.
So a standard 2X fund should have returned something close to 34%, right?
In theory, yes. But TSLO, the 2X capped fund that's supposed to accelerate those gains, it only went up 8.45%.
Wait, so you're telling me the investor paid fees for a leverage product and ended up with less than half the return of just owning the stock?
That's right. You paid extra to underperform. The leverage you wanted was completely wiped out by the fund's cap structure. This is exhibit A of the failure. If the stock has a huge month and spikes 30%, the cap might limit you to, say, 15%. You are structurally guaranteed to miss the best part of the rally.
Okay, what about a sideways case? Let's look at exhibit B Palantir, PLTR. It gained a respectable 9.91% over the period.
The capped fund, PLOO, gained 10.97%.
So it beat the stock by about 1%.
Barely. Our sources just call that statistical noise. It's not accelerated returns. You've paid for all this complexity just to gain one extra percentage point.
And now for the big one, the downside protection. Let's look at a real bear case. MicroStrategy MSTR got crushed. It fell 46.81%.
A brutal drop.
So the capped fund, MSOO, which is supposed to limit you to only 1x the downside, what happened there?
It crashed 44.95%.
So the protection saved you less than 2 percentage points. On a nearly 50% loss, that's basically nothing.
It's a rounding error on your loss. And that's the brutal math of it. If the stock crashes, the fund still crashes right along with it. The downside cushion is effectively useless right when you need it most.
I think there was one case where the protection looked a bit better with Coinbase. Coin was down about 17.48%.
Yes, and the capped fund, COIO, was down 10.82%.
So that did save the investor a decent chunk of the loss.
It did. That was the best example of it working. But you still lost over 10%. The fundamental problem is always the same. These funds cap your winners while only giving you the illusion of protection on the downside.
So we boil all this evidence down. The verdict seems pretty clear. Our sources called these capped accelerated products a solution looking for a problem.
And that's a perfect way to put it. They legally limit your winning trades while doing almost nothing to cushion your losing ones in a meaningful way.
So who are they for then?
They're designed to appeal to investors who are, terrified of that volatility decay, but are also desperate for some kind of accelerated return. But mathematically, they just don't deliver either one effectively. The whole structure is just designed to underperform its own marketing.
So what does this all mean? The final advice for you as you look at these products really seems to be about knowing the difference between the two product lines.
It's simple. Leveraged shares is a genuine game changer, but you have to be very surgical about which of their products you choose.
The fee war is a gift to traders.
Absolutely. The lower expense ratio and that safer physical replication model on their 2x daily funds, the TSLGs, the NVDOs, that's a huge structural advantage for any active trader. You should enjoy those savings.
But the capped accelerated funds, the TSLO, PLOO, MSOO, our sources say those should be treated as a clear no-go.
The data is undeniable. It's a high-cost compromise. The math just doesn't work out the way the marketing pitch says it does. You just can't confuse the quality of one product line with the flaws of the other.
So the final thought we want to leave you with is this.
When a company offers you an honest-to-goodness, structurally superior product in one hand, and then a mathematically compromised one in the other, which of those two products tells you more about their real strategy? It really makes you wonder if this is about giving traders a useful tool or just about seeing what the market would pay for a story that sounded too good to be true.